Buon pomeriggio, penso che possiamo iniziare. Buon pomeriggio a tutti, anche a chi ci segue da casa. Partirò adesso in italiano, poi dopo la presentazione sarà in inglese, perché appunto siamo, come dirò a breve, siamo una società di consulenza con sede a Londra, quindi anche per il mio collega parleremo in inglese durante la presentazione. So I start to introduce myself. I'm Alessio Cunico, Head of Analytics of Timera Energy. And I'm here today with James Laudage, my colleague. Do you want to introduce yourself here?
Hi everyone, I'm James Laudage and I'm a senior analyst on the power team at Timera Energy, and I work on battery transaction projects across Europe with a focus on Italy, Germany, GB and the Netherlands. Today we're going to be talking about building a bankable battery investment case in Europe.
Yeah, let's go through the main contents of this speech. So first we will go through a review of the landscape in Europe of the battery investment case with the drivers of the revenue stack across Europe, taking a perspective more on what is in common between different markets, going toward what makes actually bankable for what we see currently, an investment case in battery investment across Europe, that is the offtake and the commercial structure around it. Finishing with the key investment challenges that we are currently seeing across Europe. So I start just with a very fast introduction on the company for the guys who do not know us. We are London-based consulting. We focus our consulting services in energy, supporting investors in deploying capital in energy, especially in power markets across all Europe, and also in gas and LNG markets with a global perspective. And we are specialized especially in the valuation of flexibility across power markets and gas and LNG markets. So in understanding actually which is the value from having a flexible contract or a flexible asset in this landscape. Let's start with the three structural drivers that are supporting the battery investment case. So they are very basic stuff, you know. The three main drivers are the renewable penetration, of course, but there are also other two very key ones that sometimes are not taken into consideration properly, according to us, which are thermal closures. We are seeing phase out of coal assets in many countries, but also more conventional CCGTs in countries where the capacity markets are not there to sustain the business case, as well as some nuclear capacity, like for example in Belgium. And all this kind of dynamics creates interesting opportunities for batteries, together with what to expect at demand level. So we are expecting a demand growth in power markets, not driven just by electrification of heating and transportation, but also because of the intensity of computational services, especially around AI, even if right now there is some uncertainty in the actual demand that these kind of services will require going forward. But these three drivers are captured in a big challenge that we are seeing currently in Germany especially, but also in other markets that it's, let's say, it's represented here on the chart on the left-hand side of the slide that represents the rated capacity. The derated capacity, we mean that like CDP for you guys that are focused on the Italian market. So basically the capacity that at probabilistic level is available to support the market adequacy, the system adequacy. And we're seeing, of course, an increase driven by renewables. Even if the nominal capacity is huge, the actual derated capacity is very tiny. It's around 10% on average across different markets. And the reason is that renewables don't produce when you want. They're not plannable. They're not programmable, of course. But at the same time, we see a net decrease that is driven by an increase on demand that we're expecting, especially in countries where the data centers will be a very important business case. but also due to the other factors like electric heating, and electric vehicles. Together with a phase out of conventional plants. And so in Germany, we are seeing, if we take a perspective that considers just this technology, we are seeing a net deficit of system adequacy. And this must be recovered in some ways with new capacity. And batteries are for sure one of the main ones, because batteries, besides of providing a high derated capacity with their, especially for longer durations, they're also able to capture and solve one big issue that we are seeing on the other side of the slide, that is driven mainly by the first driver, that is the actual volatility within the day of generation, of course. That is pretty clear with solar, because if we take a look at Germany, currently in 2025, we have already overcome 100 gigawatts of capacity in solar being deployed in the country, and we are seeing a distribution of the swings, so the power, the difference between the maximum power generated and the minimum power generated within the day, that is in the range of from 25 to above 50 gigawatts of generation. So this is a huge ramp that needs to be satisfied, let's say, from a flexibility point of view. So the requirements is not just driven by the price signal, but it's also a physical requirement that will increase a lot also in going forward with the deployment of renewables, with 2040, where we are expecting after curtailment, so post-curtailment, a distribution that is well above 50 and that can go so close to 200 gigawatts. So this already provides a spectrum of what we expect the need for flexible capacities to be. This is not just batteries that can satisfy this demand, but it's also other kinds of flexible assets from the conventional one, but also electrolyzer. We're expecting to have a huge role, especially in Germany. So now I leave the floor to James to go on the next steps of the presentation.
Thanks, Alessio. So yeah, we see there's a huge requirement for more flexible capacity on the system, but we have known that this would be the case for quite some time. So what has changed recently that is making battery investments more bankable? We look here at three factors which historically were roadblocks to investing in batteries, but we've seen these subside significantly in recent years. So first of all, regulatory barriers. Old regulation was made without taking batteries into account, and therefore when you try and apply that regulation to batteries, it might not be applied fairly. Examples of this are grid fees. So in some geographies, both consumers and generators are charged separately for the grid connections, but batteries might be double charged and treated in a penal manner. Regulation takes a while to change, so this has been quite slow to fix, but we've seen this starting to be cleared up now. An example in the Netherlands, which still isn't optimal compared to other countries, but they have introduced non-firm grid connections, meaning that they're effectively designed for batteries, that they can turn down the grid connection battery of that battery at times of peak in one direction. So they'll turn down the consumption in terms of peak demand, but that won't matter because you unlikely want to be consuming, and they'll turn down generation in times of low demand and excess generation. But again, price signals will make that impact less significant to batteries than perhaps other technologies. Second is market restrictions. So in order to have the most attractive battery revenue case possible, you want to stack as many revenue streams from as many different markets as you can. Again, that in the past hasn't always been possible. It varies by country, but batteries haven't always been able to qualify to provide ancillary services, for example. They might not have met the pre-qualification requirements, but we're seeing that open up. We're seeing batteries participate in all their revenue streams. A recent example being in Italy, batteries starting to participate actively in secondary reserve. And then also CapEx, with batteries being a relatively new and evolving technology. We've seen big changes in this over the past 5 years, more of which we'll come on to later. But both capex costs have come down, and the technology has meant that degradation per cycle has come down. This effectively is like a double improvement for the capex, because you'll have to replace your cell less often, and it'll cost less when you do so. And this therefore opens up the opportunity to pursue energy arbitrage strategies with multiple cycles a day, rather than being limited, if your warranty restricted you to one cycle, to perhaps an ancillaries only strategy. So that's general trends across Europe, but which geographies do we currently see as the most attractive, and why? We look at a few here and categorize these into 3 buckets. So the best ones, dark green, we call mature and scaling markets. In the middle, then new frontier markets, and at the bottom, emerging markets, where we're starting to see interest pick up, but not yet a lot of capital being deployed. So if we look at the countries we see as the most attractive, we have GB, Germany, and Italy. GB and Germany have those strong fundamental drivers of renewable build-out being very strong. Germany focused on solar, GB more offshore wind driven, but also those impending thermal asset closures like we saw on Alessio's slide. For example, that in Germany, closure of the coal fleet, in GB, aging gas assets also closing down. Italy is different in this regard, because what makes it attractive is, of course, the Maxi scheme and the capacity market, enabling you to get these guaranteed revenue streams, de-risking the project, and therefore opening it up to a broader pool of investors. In that second category, we have the Netherlands and Belgium. These markets have strong fundamentals, but still some uncertainty or regulation which makes them slightly less attractive to other markets. Using Netherlands as an example, they have grid fees that are substantially higher than Germany, and similar fundamentals, which can cause investors to look to Germany instead of the Netherlands. Then Poland and Spain, 2 markets where we're starting to see interest spike, but capital deployed is yet to really take off. That's due to high levels of uncertainty. In Poland, there's uncertainty about what will happen with the coal fleet. And in Spain, there's been uncertainty for many years about what will happen with the capacity market, and that's still ongoing. So here we look at the day-ahead revenues. We looked holistically at the last slide at long-term investment, what's more attractive. Here we look in recent years, where has the best revenue opportunity been? And we've taken day ahead here, as this is an easy metric to quantify. We acknowledge it's just one component of the revenue stack. Looking at the left-hand side, we have a chart showing a select few countries or zones in Europe, and we've run a perfect foresight optimization model over the day ahead prices there for 1 hour, 2 hour, 3 hour, and 4 hour batteries, and represented the incremental benefit of each of these additional durations as a stack. We see the most attractive markets in 2024 were Poland, the Netherlands, and Germany. Germany and the Netherlands, this is due to that high level of renewable build-out, so causing those negative prices, which I'm sure we've all heard a lot about, but also those low prices you can charge for cheap, increasing your spreads. Poland might have had a bit of an anomalous year in 24. As you see, it's very different to the black line, which was the sum of that stack in 2023, and we'll come on to why that is later. If we look at the rest, we have 3 Italian zones on there. We've shown Sardinia, South, and North. Sardinia had the highest day-ahead revenues in 2024. This is because it has low levels of thermal flexible capacity and also had significant interconnector outages. The opposite of this is the north, with the most levels, the highest thermal flexible capacity, and it's the best interconnected of the zones. If we look on the right-hand side then, we talk about the difference in what this picture looks like in 2024 versus 2023. Blue markets are shown as those where 2024 revenues were lower than 2023, green being higher. And one thing to note, looking across, is there's a mixture. Some are blue, some are green. Looking at the blue ones first, we have GB and Italy. These markets spreads are very largely driven by gas prices. These do affect all markets, but they were dominant in these two markets. And across 2024, at least in the first 3 quarters, gas prices were a lot lower than the average in 2023. They did pick up in the end, but that was enough to bring down those revenues comparably. Next, if we look at Germany, you see plus 17%. That aligns with their increased renewable build-out, increasing that occurrence of negative prices as one thing, but also just driving generic power market volatility. And then notice Eastern Europe. This is plus 90% in Poland and equally high in some other geographies in Southeast Europe. This was, you could say, an event-driven occurrence. Over summer, very high temperatures caused record levels of power demand due to air conditioning demand, and low cross-border flow capacity to Western Europe limited the ability to import that flex, effectively isolating these countries and causing spreads to spike. So some key takeaways from this is a good year for one market is not necessarily a good year for the one right next door. So that's a key consideration when looking at developing a portfolio. And also abnormal, not completely uncommon, but low probability, high value events can really cause revenues to change massively year on year. So I spoke in the past slide about the impact of gas prices and renewables. So we look at them here in a bit more detail. On the left, we've plotted 1 hour day-ahead spreads. Sorry, I'll let you fix that. Thank you. So on the left, we've plotted 1 hour day-ahead spreads in GB against the gas price, NBP. We've chosen GB here as it's, in terms of renewables, an offshore wind-dominated market, and this doesn't have a particularly strong seasonal profile. So therefore, you can see that correlation very clearly. Gas prices will also impact spreads a lot in most markets, but that correlation may be overshadowed by seasonal renewable generation. But as you see, the lines follow each other closely, and spread picked up at the end of 2024 as gas prices did. On the right-hand side, we look at cumulative negative price hours in the German market. So as you increase your renewable generation, the frequency of renewables being on the margin increases, causing prices to go negative. We see here the dark blue line being 2024, significantly higher than 2023, having effectively passed a threshold where renewables can be on the market a lot more often. We also look at the shape of that curve and notice that it's an S-curve. This can easily be explained by the fact that solar is the dominant renewables and renewable technology in Germany. So most of these high solar days take place over summer. Therefore, the gradient, the rate of increase of the count of negative prices increases at its is at its largest during those summer months. So I spoke there about gas prices and renewables and their impact on spreads, but let's look at what this means for battery revenues at a monthly level. So we've got back-tested best revenues here. On the left, let's start by looking at GB. So we see, starting in early 24, we see those revenues fell off. That's as gas prices fell down. We see month on month some pretty significant, percentage-wise, significant changes. They're the months with higher offshore wind generation, like showing that higher level of volatility, but there's not a strong seasonal profile. It remains low until it starts to pick up in towards the back end as gas prices rally. We also have one line here showing dynamic containment. This is one of the ancillary services in GB, and you see that this is significantly below the opportunity from energy arbitrage. Effectively, that market has saturated in GB, and all the depth of that market can be served by shorter duration best than 2 hours, meaning the value is significantly below the energy arbitrage value for those longer duration assets. Now, if I look at Germany, you see at the start of 2024 a similar shape or a similar fall. As I mentioned, gas prices having a strong impact on all markets, but you see a real rally in the summer. And as you saw on the previous slide, that aligns with the occurrence of negative or very low prices from solar generation. Another thing to note is the dark green line here being AFRR, one of ancillary services, the AFRR capacity fee. And this also rallies in the summer, showing that there's still value in Germany in ancillaries. They're not yet saturated, but in a few years' time, that may be a different picture. So, some key points from this. I think I've hammered home the point that gas prices and renewables are key drivers of battery revenues. Therefore, if you want to be projecting battery revenues, it's very important you have a sophisticated way of projecting gas prices, and you're also able to capture the value in those unlikely but high value events that are likely driven by weather, such as the Dunkelflaute or those high temperatures. I'll now pass back to Alessio, who will talk through how we think you should model this.
Okay, thank you, James. So these kinds of revenues are, these kind of dynamics are under the eyes of most of the investors. So there is a key challenge that is raised by this. So it's the level of uncertainty and the level of how to measure the risk that it's coming from this kind of asset, because the batteries are by definition an asset that profit from volatility. So let's say that the way in which we think this must be captured is a way that involves understanding probabilistically what happens on the market. And this is also what we are seeing currently with equity and debt investors. They are not just interested in your view of the markets, but they're very interested in the distribution of that view, because there are very big implications around the risk management of the project and the accomplishing the different cost of capital. Indeed, we are seeing huge differences between the battery investors in Europe in terms of their cost of capital and which is the level of risk that they are able to achieve. And so the way in which we try to accomplish this complicated task is through our modeling. So we start with the basic principle, that is the one that James explored before about gas. So in Timera, we have extensive knowledge on the gas markets across Europe. And so we start with analyzing, with the first step of our modeling approach, the gas markets at global level. So trying to understand which is the role that the marginal LNG cargo plays at global level, and trying to understand which is the role that at the margin the Asian flexible demand plays, which is one of the structural price drivers across the entire globe on gas. And of course, we also consider the flexibility that comes from the power market through the gas switching curves that are, according to us, of course, it's a flexibility that is fading away with coal. But this part is embedded in the second level of our modeling. So with the power market model, here instead we take a European approach. So we are focused on the European market. So we model the pan-European market at stochastic level. So running the scenarios with hundreds of simulation of different profiles of wind, solar, and demand, trying to extract the distribution of the prices and which is the real impact at the margin, depending on the assumption and the evolution of the markets across all Europe. And through this, we're able to extract, again, hundreds of simulation and price paths against which we model the optimal trading opportunities for batteries, not just considering the physical constraints of the battery, of course, but also the real-time trading challenges that the operators face in the real world. That means the imperfect foresight, of course, that is especially important on the intraday and the balancing market, let's say. While instead this is not a key challenge on the day ahead for several reasons. And the second one is the cost of opportunity, the opportunity cost, for charging your battery, which is something that traders face every day, because of course you can optimize more your battery in one single market, but this creates lower opportunities in the second one. And this is also true for the activation and the taking position on ancillary services. So let's say that through this approach, what you see there, what we are able to extract is not just what we expect the asset to profit from the markets, but also which is the distribution of it. And this is very important because we are seeing a non-normal distribution in these results. We see a high skewness, especially on the right side, and this is not Timera that says that, but it's actually historics. You can simply see what happened in Germany in November, or what happened in December as well in the two Dankenflaute events, where basically more than 60% of the business case in those months was created in less than 1 week, due to very extreme events of low wind generation and low solar generation. So this creates a massive opportunity for batteries that must be captured to price effectively the risk of this investment case. That it's actually what makes the business model bankable for what we see from Northwest Europe. Of course, in Italy, this is not a key point yet, but we will come through that. And these are the key commercial structure that we see in Europe for the offtake of the battery. Why we are speaking about offtake? Because this is the way in which the markets that don't have capacity market of MAXE are dealing with risk and the management of risk. So with market opportunities, market options that traders are more than happy to take. So we see an increasing maturity of the market for commercial structure and offtake contracts in Europe, given that, of course, the players want to reduce their risk exposure, reducing their cost of capital, and improving their returns. But at the same time, operators and traders are very happy to take these kind of assets to rebalance their portfolio across multiple geography, especially. And we can, let's say, find, of course, these are the plain vanilla structure that we see, but with this, basically, you can create very complicated structures of the offtake of your battery. And the key components are, of course, the toll agreement, that is the lowest risk return opportunity, because basically you're trading the flexibility of your asset for a fixed revenue stream. And then toward the highest risk return opportunity, that is instead the margin sharing. So sharing simply with an energy management operator the revenues of your battery. But there is a lot of other opportunities in the middle that must be priced accordingly, and that can offer a higher opportunity to protect against the downsides of the scenario for batteries. And how can you price this kind of agreements? Just understanding which is the volatility around the business revenue, the revenues of your asset. So that's the reason why we model things in this way. In Italy there is something similar. Let's say that we don't speak a lot about commercial structures, contracts in Italy. It's not a market that is mature as it is in GB right now, or it is interesting as it is in Germany right now. And the reason is not just about the low revenues that we're seeing in Italy today, that are driven by the high flexibility that is currently available, even if we are expecting this to change quite soon. But it's also due to the regulation and the opportunities that are there today. So let's say that from comparing to what we saw here, we can see that the regulation actually today offers something for risk management pretty flexibly from the regulatory point of view in Italy. We have indeed the capacity market, but also the MAXE. But there is also something inside between these two that can allow the operators to calibrate their risk-return exposure. Indeed, we are seeing a lot of players around Europe that are interested in investing in Italy, but when you explain them which is the return that they can expect from MAXE, they actually not interested. They would like to increase their exposure because they understand the nature of the battery investment case, you can have a very few cases of that can provide you huge opportunities to profit from them. And so also banks are becoming much more comfortable today, especially in Europe, but it will be the case also in Italy, given the experience in the other markets. But they are becoming more and more comfortable in taking on the risk, the debt risk, with a business case that it's more merchant exposed. So let's say that for the merchant exposure, the maximum case, the highest risk return opportunity that the market offers today, we don't know if it will do tomorrow. There will be probably these 2028 capacity market auctions, but then we will see maybe not in the next years if there will be still this mechanism. But MAX itself is something that should be benchmarked against the capacity market opportunity. The reason is that it's a tolling agreement. So it's not like the capacity market. I'm sure that you already know that very well, but it's not like a capacity market that it's a revenue on top of the merchant revenues, but it's actually a swap. So basically it doesn't make any sense, right, to have an extreme exposure in the hybrid MAXE to the market when you have the capacity, if you have the capacity market there. Of course, it's not just a matter of risk return profile, but it's also a matter of location, because we see that actually MAX is not available in some parts of Italy. In the north, in central north, there will be zero quotas. But taking, when feasible, taking a merchant exposure can also be coupled with other market opportunities. So like the previous contracts that we saw, creating a very interesting and complex also commercial opportunity for the offtake of the business case of the battery. So let's say that the bankability in Italy is highly driven by this regulation, and that is driving down, of course, is going to drive down the cost of capital for most of the operators. But as I said before, many of these operators are not interested in having 100% max opportunity. So let's say that keeping a portion of your asset and not contract that under the Terna auctions is something that we are seeing as very, very appealing across all Europe as a business, as an investment opportunity. Because actually you see that Italy is very interconnected. There will be a higher penetration of renewables. So events like the ones that have happened in Germany can happen also in Italy in some zones. So let's say that this depends, of course, also on the risk of cannibalization of the batteries that are deployed on those zones. But of course, if you want to maintain merchant exposure, you also have to pay the price for that. But the market provides you other opportunities on top of the regulation that will not be dependent on the auction clearing price. That actually instead will be the main driver of the potential return for a investment case that will be max backed. And related to this, there is something that James previously cited about capex. So we are seeing capex of batteries, as he said before, going down very rapidly. So we saw cell prices falling of around 35% since 2020. And we are expecting this potentially to go down even a bit more because we are seeing the Chinese supply chain to be oversupplied, basically. So this could also be worsened by the US tariffs on China. And so we can see Europe to be one of the best markets for China, reducing the price pressure coming from the US market. So this is a key trend to take into consideration. That will be potentially also be taken into consideration by the operators participating in the MAXE, creating not just opportunities but also risks on the auction side. Then we are seeing other very interesting dynamics in terms of technology with improving energy density. This reduces the site capex, so the part that is more related to the DevEx, let's say, and lower degradation per cycles with, of course, the obvious opportunities there. But everything is also related to commodities because we have chemistry improvements that allow a reduced exposure to the price dynamics of some non-flexible supply chain materials. And then we see also lithium price to fall. So there are good opportunities on the side of the costs that mechanism like the auctions can transform from opportunities into potential risks. So this is something to look at for us, and that's the reason also to search maybe for a commercial structure that comes also from the market and not just from auctions. Yeah, so let's move to the ending of this presentation with the 5 key challenges that we see for building a bankable investment case. So the first one is, of course, having a robust revenue stack. So we are not seeing, even if there are huge opportunities on the ancillaries balancing intraday, we don't see a lot of confidence around the business case that is based just on these markets. And the reason is that it's much more volatile, and it has lower liquidity, so it has higher risks of cannibalization. So it's very important to build the business case around merchant revenues that are highly tied to wholesale markets, so also intraday markets, but also with day-ahead markets that are sufficient enough. And this is also related a lot with the second challenge, that is the risk management and the risk appetite. That is the key challenge for the bankability of investments that we're seeing currently across Europe. That will become, of course, the key challenge also in Italy. So having players with high difference in the perceived cost of capital, and so we see a big focus on understanding the risk dynamics and the distribution, the stochastic distribution of the revenue streams that comes from the market, from most of the players, because this is an analysis that is key to understand the best route to market. Indeed, any offtake agreements it's based on the analysis of options, and let's say that batteries can be seen as an option of flexibility from a financial point of view. So analyzing options with a non-stochastic approach from our point of view is something that the finance industry is not going to accept. And market and policy tailwinds and risks. These are key points. Of course, in Italy, policy is crucial. It drives everything so far. Have driven everything so far. So we are seeing this as a challenge in Spain and Poland, where there are huge opportunities, huge targets, but the lack of clarity around the regulation is stopping the capital to be deployed, even if there are many operators that are ready there with cash to be deployed. And then a key one on the competitive advantage, so which is the competitive advantage of your portfolio. And we see a huge focus on the geographical distribution, on the geographical the risking, so having a portfolio that is geographically widespread, not just in Italy, but potentially also abroad, because the flexibility in power markets will be a commodity and will be subject to cycles of boom and busts. So having a geographical distributed portfolio will enable the balancing of the business case of a very big portfolio investment. But it's not just a matter of geographical distribution, but it's also a matter of the right commercial structure. So not necessarily just max or capacity market, but also other less plain vanilla opportunities that come directly from the market. We are seeing operators that are more than happy than taking the opportunities also of assets in Italy that are already backed by the capacity market. There is interest in having an offtake contract with this kind of asset. So, yeah, to conclude, just some details on what we do. So we offer bespoke consulting services across all Europe on the best revenues analysis, but also on the gas and LNG investments. But we also have subscription services in the power market, battery investment analysis. We focus on GB, Germany, and Italy. So if you have any question or if you want to have a follow-up, please don't feel free to contact us. at these contacts. And yeah, I would be happy to reply to any question, if any. Thank you.
This is not strictly related to the topic you talked about, but are you performing some evaluation on the opportunities on local flexibility markets for batteries?
Yeah, that is done at MSD level, at nodal level, but let's say that we don't consider the market of local flexibility because what we usually do is more big projects. We do consulting with big projects, so we don't follow what happens on the distribution grid, for example. Yeah.
Hi, thank you very much for the presentation. I had a question on the gas model. So I understand the gas model is an input to the power model. And do you iterate the demand and price to get convergence on both the power side and gas side?
Yeah, from a flexibility point of view, this is a dynamic that will fade away a bit. In Italy, it's not yet so crucial, but it has become very crucial in the energy crisis because the energy crisis was worse than it should have been, not just for the nukes in France that were a very scary situation, not just for the hydro because it was a drought here, but it was also for the lack of the gas switching demand. What we mean with gas switching demand is when the gas of price goes up, what happens is that the market rebalances itself, covering that supply with coal or with other kind of generation. And basically, this dynamic is setting the price sometime in Europe. So there is a communication, because what we do is that we try to understand with our power market model the impact on the gas market in Europe. And this has an impact, of course, across all the globe, because Europe, together with JKT, is Japan, Korea, and Taiwan, is the biggest market of LNG. So it's setting the price quite often. So yeah, there is this communication, but basically from the external communication, let's say that it's easier to understand this flow. But yeah, there is a connection. Yeah, we're running out of time. No, okay. We can take. Okay. Grazie.
Thank you.